right, welcome to the show. Today we have Jim Maffuccio in. Jim's got a diverse background in real estate investing, turning non-performing notes into performing notes, buying and selling all types of notes, first, second position. And we're going to talk about that today, figure out what's it like, what's it look like, how do you get invested into a business like Jim's, get involved with a business like Jim's, and hopefully learn something profound here to help you guys get better at the business that you do every day. So without further ado, Jim, welcome to the show.
Hey, great to be with you, Joe. Good to meet you.
Absolutely. Absolutely. We were talking a little bit before the show, getting a little bit into the weeds with, what it is you do and how it is you do it, but tell the folks, a little bit of background about yourself and, what got you to this point.
All right. Well, yeah. So I actually graduated from college in 1980 with an engineering degree, and I went to work for, at the time, the largest corporation in the world. It was an oil company. And so I did the corporate gig for about 6 years and got the entrepreneurial bug in about 1985 at the end of the year, and got my real estate license and jumped out into the world of self-employment in early '86 and haven't looked back. Haven't gotten a paycheck from somebody else in that many years. So what's that? 34 years. And so, but I got involved in not only transactional real estate, but I got involved in doing residential development. So in Southern California, Ventura County, Los Angeles region, just doing small residential infill development. And really went through two major crises in which I lost everything. Both of them were related to the mortgage structure, the financing structure within the real estate space, as well as being in California where it takes so long to get a project approved. You never know what the market's going to look like by the time you lift the curtain, so to speak. So I had some real successful failures there. Actually won a Gold Nugget Award for one of our development projects. And I like to say it was my most successful failure ever, because we had a great little project. We had all kinds of people coming to check it out. City planners, even Hollywood location scouts came by because we created this kind of old-fashioned, Pasadena bungalow craftsman style house neighborhood. And it was really cool. But anyway, then kind of got back on my feet in development. That was in the mid 90s, and started moving into affordable housing. And then by 2007 had property everywhere, and it was in the middle of a bunch of projects, and everybody knows what happened then. So the bottom fell out of that thing again, and found myself, very long story, very short, found myself moving to Kansas City with my wife and 5 teenagers underfoot. And so that was in the 2007 timeframe. Started doing whatever I could to put food on the table, because I was broke. I mean, I lost everything. I actually lost more than everything. I lost stuff I didn't even have yet in that crash. And so I started kind of studying all of the train wreck that had just happened, and I really, through some divine intervention, discovered this whole area of distressed mortgages, and said, I've lost my business twice because of debt, and I think it's time to get on the other side of the debt equation and be the lender and not the borrower. So I started attending conferences and learning about buying distressed debt, buying all of these loans that these institutions needed to get rid of, or else they were going to go under. And of course, a lot of them did go under. And so I bought my first mortgages in 2011. And again, just through studying the situation, I discovered a handful of people were doing seconds, doing junior liens. And it sounded like insanity to most people that have been around real estate and around mortgages. And why would you buy defaulted second mortgages? And there's a lot of misinformation out there, which of course creates opportunity, because having a knowledge advantage is always great. But a lot of people are under the impression you can't foreclose from second position, for instance, and that's absolutely not true. You're secured by the collateral, just like a first lien is. It's just that the tactics are a little bit nuanced. Fact of the matter is, institutions will typically not foreclose from second position. They'll charge the paper off and get it off their books, which creates tremendous opportunity for guys like me. So I jumped in 2011, proved out the model with a handful of investors, and then I hooked up with my current business partner in 2012, and we started Aspen Funds, and we have been growing. I mean, we're growing right now during this coronavirus. We're actually, I think by the time the dust settles from this thing, we will have hired 3 or 4 new people. We're interviewing one today, as a matter of fact. And so,
Awesome.
yeah, so there was there was a whole bunch of opportunity in the marketplace a couple of years ago, 2, 3 years ago, in terms of distressed mortgages. You could find them. What's happened, like any industry, a lot of the seasonal folks have kind of come and gone. A lot of the mom and pop people that just wanted to take advantage, get the cream off the top, and that's great. You know, I've been an opportunist all my life, but we'd actually built such a great company and systems and processes, and gotten all this licensing, and we've gone through all the regulatory pain, and all of a sudden we realized, wow, we're actually perennial players in this space now. So what we do now is we're actually a hedge fund, and we run different mortgage funds, and we have passive investors that we've been providing really good returns for our accredited investors. And so we have basically 2 sides of our business. One side, we go out and we buy these non-performing mortgages, and some of them haven't had a payment in as many as 10 years. So it's always a fun phone call when our team has to wake up these borrowers and say, hey, by the way, what are we going to do about this debt that you owe? And of course they're in denial, or they're mad, but in a lot of cases they say, oh, we just needed to know where to send the check. Tell us we want to pay it off. And we actually had one come through just last week, a full payoff on a loan I think we paid $4,000 for, and we got a check for $36,000. They just didn't know where to send it before. So we love those. That's not the norm. That happens, a handful of times. But so we buy the distressed mortgages, and we try to work with the borrowers. We've kept a ton of people in their homes. We very rarely foreclose, less than 2%. We have to start foreclosure a lot, but we don't finish it many times at all, because sometimes it takes that to just get people to come to the table and realize that you do still owe the money. So we're able to forgive a lot of debt, make it real affordable for people to stay in their homes. And as I mentioned to you before, Joe, we are, having done this 8 years, overall portfolio wide, we're making about a 2.2 to 2.5x on our acquisitions cost of these assets. So it's a really elegant model. It's very relationship based, and we just keep growing. On the other side of our business, we buy reperforming mortgages. So these are loans that institutions wouldn't want to touch because they've had some train wrecks in their history, but they're back on track for the most part now. And we buy these at in the low teens to mid teens is our yield upon purchase. But since we buy them for a discount, like typically 60% of what's owed on the loan, we call that UPB, unpaid principal balance. So we'll pay 60 to 65 cents on the dollar for those, and earn a nice, 2-figure yield while they're paying. And then, every quarter, a handful of these things pays off because people go out and refi their loan. And of course, we don't get back our 60 cents on the dollar. We get back $1 on the dollar. So we get a nice windfall when these loans pay off. So we've been building that side of our business. And again, we have passive investors that they just want mailbox money. And so every month, their share is deposited ACH right into their account. We pay a nice, strong preferred return to them. And it's been great. We've got this thing figured out after 8 years, and we're actually in our rapid growth phase right now. So we love it.
Cool. I'm gonna backtrack a little. That was a lot and a lot of good information. I'm gonna dive deeper into some of those pieces. Let me backtrack back to the beginning, because the show is called The Legacy Blueprint, and we're talking about building long-term legacy and leaving a legacy, but all the ups and downs that go along the way. I love to focus on. I call them like your favorite failure and stuff like that. Like right now, you've gotten to this point by ups, downs. There's a lot of people that watch and listen to this show. Our audience is anywhere between, say 20 and 35, 40-year-olds, right? And these are people that are going through the same ups and downs. I just did a post earlier, about getting kicked in the face, right? And the analogy was, over the weekend, UFC just opened up again, right? And I don't know if you watch fights, but the fights came on Saturday, and these guys get paid to go in the ring and get kicked in the face and take it, and then win inevitably, lose sometimes, but always come back. And I think that's what makes the most successful people out there in business successful. Is you don't see all of the problems, you don't see all of the kicks in the face, you don't see all of the downs. You tend to see people look, like people at the bottom aren't sitting here doing podcast interviews, right? They're talking about the challenge they had, and now they're talking about the success and the upside of what those challenges created. But how did you bounce back twice? Like when you were in that spot, you actually said one of those times you were lower than zero, right? You actually created more problems than you even had to begin with. How did you get the guts and the willpower and the confidence to pick yourself off the ground and then go create something like this business?
Yeah, well, there's really two sides of that story. Actually, not sides. I mean, one's internal and one's a little more external. And so, first of all, my faith in God is that's the anchor in my life. That's my true north, ground zero, and everything flows out of that. So, I just because of my faith, I'm an optimistic person. I just believe things are supposed to work, and when they don't, we get to learn how to fix them, and that makes us bigger and better people. So that's just kind of a DNA level way that I view life. It's a very hope-filled perspective, and then the other aspect of it is, I mean, look, when you have a couple decades at that point, I've over 3 decades now of experience in an industry, experience not only as an entrepreneur, but experience in real estate specifically. You just kind of know what the moving parts are, and you look at, okay, this train wreck just happened. Let's look at the pieces of the puzzle. You still have human beings that need places to live. Okay, the houses aren't going away. They're still sitting there. The ownership of the houses is changing hands in a lot of cases. And the underlying financial structure is the first lien or the liens against the property. The owners of those liens are going to change hands too. But at the end of the day, you still got people. They're still going to be living in houses, and you're still going to have mortgages. So I just had to transfer my skills from being on the property ownership side of it over to the paper side of it. And so it was actually, I mean, that part was pretty easy for me because again, you just learn a different, skill set, but it's the same game really. So,
I love it.
so I just started, I mean, in 2010, literally I went to my first distressed note conference in the fall of 2010. I heard the testimonies. I saw, I saw the thing and said, this is real. This is absolutely where I want to be positioned. And so I just started gaining the knowledge and honestly going to conferences, networking with people that I'd never met. I'm 63 years old, and wow, yeah, I'm going to be 64 this year. So to reinvent in your mid 50s sounds, intimidating to some folks, but it's like, look, when you're an entrepreneur and you have a family, you just do what you got to do. And
yeah.
I've probably been a smarter worker more than a harder worker most of my life, but I don't mind working hard as well. So just again, retooling my raw understanding of real estate, tooling it into this mortgage thing, and really building relationships, because it's such a relationship business, especially the world we're in with second mortgages. You can't, I'm telling you, you can't find these things in any kind of volume. And so all of our sourcing is through relationships now that we've been building for 8 years. And we do what we say we're going to do. When we say we're going to buy something, we buy it. We don't donk around with people at the end of the transaction and try to chisel the price down. And we have a very good reputation as being a great trading partner. So and we treat our investors well, and they hear from us a lot, and they get paid when they're supposed to be paid. So.
I love it. I love it. So I heard a few things. One, you went to an event. I think far too many people just aren't investing in themselves. And I love that the fact that this COVID thing allows people to take a step back, slow down, get better, learn, grow, do YouTube videos, online trainings. There's so
100%.
many methods to benefit, right? And then the second piece that I think that the big takeaway there is you knew when to pivot, right? And sometimes we have to be brought all the way down to say like, hey, it's time to pivot. You got to get smacked in the face a little bit, but sometimes just having that ability, like that keen intellect to say, I know what I know. I know what I can control. I know what I can't control, but now it's a good time to pivot. And this is the pivot I'm going to make into. So I love the fact that you were able to create that opportunity for yourself, for your family, and ultimately come out, on top and be running this awesome hedge fund and ability to help people in the second position. Now, you said something earlier on about foreclosing in a second position, and I run in a lot of real estate crowds. That does seem to be the common thought, the common process is, well, second position just doesn't have a position. So Walk us through that a little bit. What does that look like? Do you have to take back the first position? Do you have to, like, how does that negotiation happen?
Yeah. So, well, I'll start from the 30,000-foot view. Is that you have a lien on the property, just like the first has a lien. Obviously, if I foreclose from my second position, I don't wipe out the first. If the first forecloses and I don't defend my position, I can get wiped out. So if there's not enough equity in the deal above the first lien and the first forecloses, I have less and less options to get out profitably. But in cases where there's equity enough to cover my payoff balance as well as the first, if I foreclose from second and I'm the successful bidder at the auction, in other words, nobody bids for it, so I end up with the second lien goes away, and now I get title to the property subject to the first. So it's actually a lot of people in our space. Well, I won't say a lot, but there's a handful that actually use buying defaulted second liens as a property acquisition strategy, because they have their eyes on the property and they get the property in a sense with built-in financing. Now there are exceptions. There's some states that I do not have the automatic right to reinstate the first. But in most states, I actually can catch up the payment. If the borrower has gone dark on their first lien as well as on their second, I can step in and to protect my secured position. The law in most states allows me to step in and make the payments on that underlying first mortgage. So what have I done? I've just purchased a property subject to, in a lot of cases, a really sweet loan with a very low interest rate. So
very interesting.
A lot of people
very interesting.
A lot of people are under the impression that, well, if you foreclose from second, you have to pay off the first. And that, for the most part, that is absolutely not true. And honestly, even in cases where it is true, where the first can accelerate the loan or call a due on sale. So there's still a lot of time in between when that first goes, 30, 60, 90 days delinquent, and they get around to starting their foreclosure process. So if it's a property that, I'm going to take back and we're going to maybe do a fix and flip on it, or we're just going to maybe do a cosmetic prehab and just sell it retail, I've got plenty of time to exit that property before the first would ever even get close to foreclosing anyway. So that's just a big piece of misinformation that's out there, is that, oh man, you can't foreclose from second because you have this big first in front of you that you have to pay off. No, the property pays off the first. I don't. That's really
interesting. So it's really interesting. I like the theory. So where do you find? You said it's difficult to find these. You have to have a network of people that can help you connect. If somebody wants to get into this business and kind of do what you do, where do they even start? Where do they find these seconds, and then obviously raise the money and so forth?
Yeah. So most people that are training the note business, I mean, you'd be probably looking at getting into first, buying defaulted first liens. Those are a little more available. There's exchanges out there. I would honestly say attend conferences. Of course, right now, that's online, so you have to do some research online. And if anybody's interested and they want to reach out, off the air, I can direct people to some great trainers. Again, we don't do training. We don't have any educational products to sell, but we're pretty open-handed with helping people out, helping people find direction. If you want to jump into this world, getting into seconds, it really is relationship based, and the only way you're going to really crack through there is establish yourself, meet the people that are doing it, and just be a person of integrity and get into the circle. There's quite a few more people doing firsts again, and you can meet them online. You can meet them at conferences. So it's there's a whole world there. Like anything else, once you get your nose inside the tent, you realize, oh my goodness, there's a whole industry here, and there's always been a defaulted loan industry. I didn't know about it particularly. I was on the periphery of it when I was a developer. Yet I'm sitting there flipping up against it all the time as a borrower. I've borrowed more hard money than I've ever lent out at this point.
Sure.
I knew that whole world existed, but now I'm in it. So.
Now you said you also buy performing notes, right? You have a fund for performing notes. So what does that look like? How do you get paid on a performing note, or how do you buy? Are you negotiating interest? Are you negotiating, payoff amount? I mean, how does that work?
Yeah, well, we have a pretty elaborate due diligence process that we analyze every single loan we buy, even if we're buying a pool of hundreds of loans. Of course, we can't do as deep of a dive up front, so it's gonna be a discounted price. We got to price in some risk if we can't go deep enough. But we look at the loan, we look at, there's really the three P's in the paper world. There's the property, there's the paper, and there's the people. And our due diligence drills down pretty deep into all three of those categories. So we have to look at each deal and say, if we had to end up with this property, okay, first of all, on that side of the business, we're buying loans that are already performing. They're cash flowing at some level. So usually they're loans that have been modified by a prior workout fund or maybe an institution. And the institutions can't keep these on their books because they're considered scratch and dent or worse. And we don't care if somebody's, say, a rolling 90, and that means they had a 90-day delinquency way back when. They never quite got caught up, but they're making a payment every month. That's fine with me. I don't care. In fact, it's to their benefit to catch up the 90 days, and we can actually help them do that, because if we can help them improve their credit score, then guess what? They can go refinance, and when they refinance, they pay us off 100%. And keep in mind, we bought the loan at a discount. So if we buy the loan for $75,000, it's a $100,000 loan. If they go get refied, it's a great day for us because we get $100,000. We just made an additional 25 grand profit on an already profitable transaction. So when we buy these loans, we're buying them typically at anywhere from 11 to 17 or 20% yield on our invested dollars. Now, that's not the interest rate the borrower's paying. They may be paying a 7, 8, or 9% interest on their, we call the coupon rate. That's what the borrower's paying. But because of the discount we bought the loan at, our yield is in the teens. So yeah, we negotiate that price with the sellers. It's a real supply demand scenario. There's a motivation level. We've had a fund recently that's put a whole bunch of paper in front of us to look at, and because of this COVID thing, and I think they're running scared, thinking that everybody's going to default with all this unemployment, and so plus I think they had other opportunities they wanted to deploy their capital into. So we're definitely bidding more aggressively today. We're bidding at lower price points and higher yields. But the fact of the matter is, in our portfolio, and I thank God for this, but we have not seen this big increase in defaults, which we actually expected a pretty good bit of it. We underwrite the portfolios that we buy to be able to withstand up to a 30% default rate. Now that's going to be uncomfortable, but we've never seen anywhere near that. It's been ticking along at under 10, and we might just bump above 10 during this COVID crisis. But even there, Joe, these are people that they're not out of the workforce forever. Most of the jobs that have been lost, as soon as businesses open back up, they're gonna be right back, doing what they do. So
I think a lot of people are missing that fact, right? No, go ahead.
Yep.
No, go ahead. Sorry.
Yeah, no.
I think a lot of people are missing that fact right now. You got 20 million people unemployed, and but every business in America is shut down and doors are locked, and you're not allowed to go in there and buy anything, right? So what's going to happen as we start to open up? Of course, yes, there's going to be some businesses that are wiped off the map, and there's a lot of businesses can't handle 2-3 months with no income whatsoever. Right. But there's going to be some businesses that took advantage of PPP, kept their people employed, kept things moving along, right? And then they're going to pop back up and they're going to go back to work. So that 20 million is going to come down. My guess is almost as fast as it went up. When people go back to work. I think we're also training people that unemployment is a good thing, and there's a lot of people on unemployment making more money than they would if they went to work. So that's going to be a tough bridge to cross when it happens. But the reality of it is, like you said, I think a lot of people are expecting massive default, and I don't see it happening that way. Depending on how long it takes for the country to open back up.
Yep, that's right. And at the end of the day, again, it goes back to what I said when we got into this space. You still got people, they're going to live somewhere. You still have the housing stock, and you still have the mortgages behind, that are holding up the housing stock, because most properties are mortgaged. So all those moving pieces are going to they might get reshuffled at some level, but people are not going to move out into the street. Our system is not going to allow that to happen. And I'm thankful for it, frankly. I'm
Yeah.
thankful that we have a safety net in this country. I hope people, a large percentage of people don't take advantage of, like what you said before. You have more money coming in, being on unemployment. I think people, honestly, I think people like to work. I think people actually
They
find
do.
dignity
Yeah.
in going. And I have confidence in our citizens that folks aren't going to say, hey, why should I go back to work? I could sit home and watch Netflix and get paid. I mean, most people don't really want to live
Yeah.
that way. So I'm
100%.
very hopeful. I think it's going to take a while. I'm like you. I think there's a lot of businesses that aren't going to come back. Frankly, I think there's a lot of businesses that aren't going to come back. And those business owners, when you get past the trauma of it, are going to look back and say, man, that's the best thing that could have ever happened to me. We really weren't making it anyway. We were just scratching by, and this kind of helped make the decision easier. And they'll reinvent themselves, and they'll jump into a new gig. And, I think we'll have better restaurants. We'll have better education. I think the whole educational system this is going to be a big part of a change. It's going to happen over time. And, you don't need, same thing with working from home and working remote. I've been asking the question for decades, why do people jump in a car to transport their brain from one part of town, an hour commute to downtown Los Angeles, to go sit in a building and maybe meet with people once a week, and then jump back in the car and drive all the way home? It makes no sense to me. So
I've been saying this. I've been saying this for weeks. No. I think I'm right on the same boat with you. I've been saying it for weeks. This is, when we get hit with adversity like this, it naturally creates a reset button, but it also forces you to look at the things that you should have been doing all along. Right.
Right.
Can you work virtually? Yes. Can your kids work from home? Can they be homeschooled and be productive? Yes. My kid's getting through school in 2.5 hours a day. Why does she need to spend 8 hours in an institution where my tax dollars are paying for an old decrepit building because it's historic and we're trying to keep it looking like that? When the reality of it is, the future 10 years from now, I don't see kids going to school. I don't see colleges being a thing. I think, virtual, first of all, technology, we can go down this rabbit hole for forever. But I think the way technology works, in 10 years from now, you might be downloading a microchip into your phone and learning everything you need to learn, plugging it in the back of your neck. Who knows? But the fact is, right now, we're archaic, and the way we do things. And this is a great nature's reset button to say, hey, maybe you should be doing things a little bit differently. Right.
Yeah, I definitely think so. I think there's a lot of things that will change.
I want to go back real quick just to clarify for some of the folks that are listening, because you said, sometimes when I do these interviews, we speak at a high level. We don't even think about we don't even know what we don't know, right? So we say things they're fast, and I think what's really impactful about one of those things you said a couple minutes ago was how you buy something at a discount and you artificially, I don't even want to say artificially is the wrong word, but you inflate the rate of return, right? So in other words, if you bought a property if you bought a note, it was $100,000 payoff, and that note rate was 10% at $100,000, and you paid 50 grand for it, your realized interest rate is now 20%, right? Is that basically how it works?
That's yeah. I mean, we actually drill deeper and actually calculate the true cash on cash, because a lot of the money coming back in is principal payoff. So we don't consider that profit. But half of that's, if on your 50% example, half of that. So we take the P&I payment that comes in, the portion of that P&I payment that's principal, half of that portion is profit, and half of it's just getting our money back. So it's not a perfect 20, but it would be in the high teens. That example you would be in the high teens. So you're exactly right. It's our investment. It's the cash flow coming in on our invested capital. That's our internal yield. And that's exactly how it works. So in that case, Joe, we make 20% until it pays off, and then we make another 100% on our capital.
And then you bump it back up again. I love it. So
and that happens. I mean, that happens, once a week we get a payoff out of that income fund, and it's a sweet thing. So yeah,
I love it. I think our listeners are going to learn so much from this, and also learn maybe an industry they're not experienced with, or maybe they want to get into. So I know we're getting long on time here. I want to make sure I respect your time. Tell me, Jim, if you had to go back to 1980, Jim, just graduated college, getting ready to go out and take on the world, what would you tell that? What would you tell that young kid that's coming out of college, and how would you effectively try to give him a roadmap to success?
Oh my goodness. Well, I'd have to, first of all, I would ask them to spend some time, in solitude, figuring out, really, really, what do you want to do? What do you want to do before you leave the planet? And, do you have any kind of gut level sense of a calling? Like, I mean, some people, like, I'm drawn to the education world. I'm assuming you mean like somebody that already knows they want to get into real estate, or are you just going up higher and saying just life in general? Because I don't want to
Let's
get
talk
too
about you.
okay.
Yeah, I
Life in
mean,
general.
yeah, no,
I would
yeah.
I would say work on you. Do personal development. I've started into personal development as way too late in life. Because I went through did the college thing, and they don't teach you personal development in college. They teach you how to manipulate numbers and whatever. But so become a student of yourself and become a developer of yourself. So educate. And I don't mean by that go back to the college and get the MBA. Maybe you do that if that's your gig, but there is so much information available. You can literally I'm convinced you can be whoever you want to be. Okay. Now, if you want to be like a track star and there's certain things, certain things about our DNA and the way we're structured. Like I'm 5'8", so I'm probably, unless I'm a Spud Webb, I'm probably not going to be an NBA basketball player. Although I still believe a 5'8" guy that sets his heart on that could do it. So, but figure out who you are,
Yep.
and again, that can get very spiritual. It should, but figure out what you really want to see yourself do, and talk to a lot of people that are further down the road than you, that maybe people that you admire, and say, I love this person's lifestyle. They work from home. They don't seem to be stressed out. They're spending a lot of time with their family and kids. And that I've been blessed to be able to, that's my story, because I've worked out of my home. This COVID thing is kind of laughable. You mentioned homeschool. We homeschooled our kids by choice, number one. I've worked from my home by choice. So this isn't anything radically different for me. This is just life as usual. But figure out what lifestyle you want, and figure out what impact you want to make, and then go get the knowledge by talking to people that are doing it. And I mean, with the internet and the information we have available right now, nobody has a good excuse. You really don't. So, and then I'll just leave one more point that I like to say is, a lot of people say the best way to learn is get out there and make mistakes and learn from your mistakes. That's a good way to learn. I'm going to say that's not the best. That's the second best way to learn. The first best way to learn is learn from my mistakes. Okay. In other words, be willing to talk to people that have, a little bit of different colored hair and, or maybe no hair and that have been through it. Like you said, that have those scars, that have been punched in the face, and say, what would you do differently? Tell me some things I could avoid. If I could go back and talk to my 20-year-old self, I could have avoided 2 train wrecks. But then I look at life and say the train wrecks are what really build your character and make you who you are. So, but you really can learn from other people's mistakes, and you can learn from other people's successes as well. So that's what I would say is really be intentional. Just don't be a Netflix addict. Don't just watch sports on TV and live your life vicariously through other people. Actually get in the game and play, become the best you. That's the best thing I can tell somebody.
I love it. I love it, man. Jim Maffuccio, building an amazing legacy for him and his family, also giving you guys the keys to build your own legacy. Jim, how do people find you, reach out to you if accredited investors want to get involved in the fund? What's the best way to reach you?
Yeah, I'd say just hit up our website. It's aspenfunds.us. So ASPENFUNDS.us. And there's a spot there where you can, a contact us link. And if you just type out what you're interested in, if you want to find out more about the industry and get plugged into it, I could certainly direct you there, point you to some education, some people that I know and trust in the space that actually do educate for note investors. If you're interested in our funds, it'll be very obvious how to indicate that interest. And if you're an accredited investor, we'd love to have you on board. And that's really it. Just go to the website.
Perfect. We'll make sure we put that in the show notes as well. Jim, thanks for joining me today, man. I appreciate it. It was a great interview.
Been a pleasure, Joe.